one of the very striking anomalies of this market compared to the markets I'm familiar with is that no one has been able to tell me hand on heart that the transfer of a credit from a seller to a buyer is a true sale, is a true transfer of legal and beneficial ownership. We've built a market that is assuming that that's the case, but there is no clear sense in which that is an enforceable statement. And that's a problem, because if we want it to be a market is a place where things are bought and sold, ownership is transferred. And if we don't have a clear, robust basis for ownership and for the enforceability of those ownership rights, then there's something very fundamental missing. There's a very fundamental weakness in the market. So we've been at pains to build a protocol that allows for the issuance and the registration of a credit and creates title to that credit that is enforceable.
Welcome back to This Week in Carbon. Today, I'm joined by Chris Canavan, the CEO of the Global Carbon Market Utility, or GCMU. Chris comes at this market from a slightly different angle than many of our guests. He's spent decades working across international economics, financial markets, sustainable finance, and emerging markets, rather than building his career entirely within or inside carbon. And I actually think that makes for a really interesting conversation, because carbon markets, we spend a lot of time debating credits and methodologies and integrity and demand. And sometimes it just feels like a circular kind of firing squad, oftentimes in terms of conversations. But Chris, I'm really excited for our conversation, because every functioning financial market also relies on something that's much less glamorous, and that's infrastructure, and that's where you sit. So that's things like data, contracts, verification, dispute resolution, common rules, and systems that allow financial institutions to really understand the risk and actually participate. And that's the great unlock that we really need right now. We spent so much time focusing on the integrity side. We now need to focus now on the buy side and start to build back the why and encourage participation in the market, and to do so at scale. And so I really want to unpack that with you, effectively understand the problem set that GCMU was created to work on, and learn a little bit about you and the work that you and your team are doing. So with that said, Chris, welcome to the show. It's a pleasure to have you on.
Thank you. It's a pleasure to be here. Thanks for having me.
Yeah. I think last time we caught up was here in Singapore with your team, and you have an excellent team. Big fan of them. So maybe I'll just jump in kind of with a little bit of a lead in. So carbon markets can be extraordinarily insular, and I kind of intimated that in the intro there. We've got our own language, institutions, and standards and assumptions, many of which people inside the market have lived for years. But sometimes an outsider sees the dysfunction that insiders have simply learned to tolerate. So you're not a carbon market lifer. When you first looked closely at this market, what struck you as unusual? Let's begin there.
Much struck me as unusual. And I don't know that I could, in fact, grasp all of what was unusual about it until I could indeed learn the argot, the jargon, the acronyms that needed to be kept straight. But once I started to get a sense of the lay of the land, it wasn't so much that it struck me as unusual. It struck me as simply a very, very nascent market, and nascent from the perspective of someone who is familiar with long established markets, whether commodities markets or derivatives markets or securities markets. So much of the raw material was there, but it really just hasn't come together. It hasn't gelled in the way it has over the years and the decades, and in some cases the centuries in other markets. And that's what has to happen. And the reason I'm confident that that's what has to happen isn't because I've got brilliant insight, but because I can't find an exception to that rule in any other market that I'm familiar with. So I think that there's a strong case to be made that this market should evolve in the same way other markets have. The big difference, of course, is that the climate crisis is upon us. We don't have a lot of time to figure this out. That's the bad news. The good news, of course, is that there is one way to accelerate the pace, and that is to plagiarize, to simply look to other markets and say, well, this seems to work fairly well in other markets. let's cut and paste, make whatever adjustments and modifications we need to make to take into account the special characteristics of the carbon markets, but change as little as possible and see what works, and hopefully learn from the experience of other markets to be able to build that infrastructure that is so needed, all of that institutional flesh and bone that's so needed in any market so that the market can scale. And this market needs to scale, right? We are here because we want this market to get big enough to have a climate impact. And at the moment, it doesn't. So that's the imperative.
Yeah, I really like that framing. And so I want to just reflect on two things that you said, right?
Yeah.
That markets have effectively, around commodities, let's take, energy complex or agricultural commodities, have taken a long time to effectively build the rails on which they operate, sometimes literally and figuratively. And then also the markets that enable for accurate and hedging. For example, you mentioned derivative markets, whether futures or options. And those took a long time to ultimately help to distribute those price signals and enable that sophistication for those markets to really operate, and for there to be a literal global market for those commodities. But carbon, as you said, it is fairly nascent. I was reflecting on this with Rich Gilmore from Carbon Growth Partners just recently, and we both use that word nascent, but it it's kind of adolescent. If we think about it, it's been 30 years since the first transactions around carbon markets were sort of first began, and then we've got compliance markets that are measured in trillions of dollars, but still it's very left field from regular sort of trade speak and kind of the zeitgeist, let's just say. But we can't afford to wait any longer because, as you mentioned, the second point, which is this imperative to actually make this market scale very quickly so we can actually make a real dent on this climate component. So then that leads me in terms of those reflections. I really appreciate that. To the next question, which is, what lessons from mainstream financial markets transfer directly into carbon, as you called it, kind of plagiarizing, and which ones absolutely do not? Like, what are the lessons that we should be applying, and what are the ones that we should be skipping or avoiding?
Well, I like the framing of an adolescent market, and part of the reason I like it is because, as perhaps many of us know, there are adolescents who age but don't necessarily mature. They remain adolescents well into adulthood, and we can't allow that to happen to this market. What I do think is clear from other markets, I guess two things are clear to me anyway. One is that there are layers of infrastructure that are properly the province of commercial actors, and those commercial actors already exist, and they are ready to step into the carbon markets because they already have a presence in securities markets, derivatives markets, commodities markets, and we know who they are. But I put them at sort of the top layer of the infrastructure stack. At the bottom of that infrastructure stack is infrastructure that is properly the domain of public goods, right? Standards, weights and measures, basic rails for transmitting information. In other markets, this is what the Depository Trust Corporation does, or Euroclear does, or what SWIFT is all about. And what is true about those is that because they're public goods, it is a layer of infrastructure that we cannot expect commercial actors to invest in, or at least not invest in a conventional sense, right? In the sense of deploying capital, building something, and expecting a dividend, a return on that capital that justifies the investment in the first place. We need that layer of infrastructure to be built collectively by the market, collectively, and with the help of the public sector here and there. Whether that public sector is investing or simply regulating, either way, we need that kind of collective action to invest in that layer of infrastructure. In other markets, when we've seen that the capital formation at that layer, it's generally been as a result of a crisis that causes everyone in the market to wake up one day and say, holy cow, we can't let that happen again. And so we've got to improve the basic layer, the basic foundational layer of the market, and we'll have to set aside our institutional jealousies. We'll have to set aside our requirements to generate a high IRR on our investments. We're going to have to link arms and build something that then helps this market get bigger and be healthy, and then we can go back to our day job and have fun making money. In In the case, for example, of the Depository Trust Corporation, which is the basic depository, the functional analog of a registry in the carbon markets, that came about because in the 1960s, securities trading reached such volume that the old-fashioned use of paper and blotters created what they called the paperwork crisis. Paper was literally piling up, and at some point, the New York Stock Exchange had to close a Wednesday every month just to clear out the backlog. And this created such a crisis that all of the broker-dealers and the New York Stock Exchange said, you know what, there is this thing called the digital revolution, the information revolution. Maybe we should digitize all of this. And that was the origin of the Depository Trust Corporation. In the case of SWIFT, for example, which basically controls global payments, a whole bunch of European banks noticed one day that Citibank, or its predecessor, had built rails. And if they allowed Citibank to continue doing that, Citibank would essentially control global payments. So dozens and dozens of European banks got together and said, we better build our own rails. And that was the origin of SWIFT. And so what happens is that, the evolution of these markets is punctuated by these moments of crisis when all of the participants set aside their own narrow jealousies and realize that they'd better invest in this public infrastructure in order to scale the market up. And that's a moment that we need to see in the carbon markets. We need to see a moment in which all of the participants in the markets have this epiphany and realize that at some point we've got to build this. We can't rely on commercial actors to do it alone. And we're going to it has to be a case of collective action. And what I think is surprising to me is that notwithstanding all of the so-called crises in this market, we haven't had that moment of epiphany.
Haven't had that aha moment just yet.
Yeah.
Interesting. Okay. So I want to kind of come back to that kind of scene setting. So thank you for that. Essentially, to understand, okay, you talked about the DTC. Let's start there, right? So it was born because Wall Street literally broke under the weight of its own growth, as you said, right? The paperwork crisis, and basically trading at scaled faster than the settlement infrastructure could handle. Is your argument that carbon is approaching its own version of that paperwork crisis? I certainly see some aspects to it, and I really want to understand how you're seeing it. Is ours due to fragmented data, the complexity of methodologies, interoperability of registries, and the kind of clunkiness of documentation, rather than the physical certificates? Or how do you see this ahead of this crisis occurring? Because the best course of action is to not have to wait for the crisis to hit, but to actually get ahead of it.
Yeah. My read is a little bit different, although I don't know that I disagree with your characterization either. My read is that in this market, there is a prevailing view or prevailing narrative that says integrity precedes scale. That if we bring the standards that deliver high integrity, then scale will follow. Then everyone will decide that it's safe to
come back
into the pool. In.
I agree. That's certainly been the narrative for a long, long time. I spoke to Amy Merrill from the ICBCM just recently, and we talked about that. That essentially, we've had 3 to 4 years of mea culpa, where we've all been kind of whipping ourselves around this integrity sort of crisis. But now that now the integrity is baked in, so now it begs the question: where's the demand? Right?
Yeah.
Now we need to figure out how to create a compelling narrative as to the why participate, and take away this excuse for not participating in the market because of a perceived integrity crisis. But interestingly, coming back to the scale piece, I really want to unpack that with you. The ICVCM was called the Task Force for Scaling Voluntary Carbon Markets when it first began with Mark Carney and that coalition. So did we put the horse in front of the cart, essentially? Did we or vice versa by now focusing on integrity? Okay.
Yeah, I think we did, because I think the lesson from other markets, which we, just scratched the surface reviewing, but the lesson from other markets is that it's not really that scale precedes integrity, but that the two interact in a much more complicated way. The DTCC came about because scale outpaced integrity. SWIFT came about because in some sense, scale in the form of Citibank outpaced the interconnectivity that was ultimately delivered by SWIFT. Even if you go back to the rise of the soft commodities markets in the US in the 1850s and 1860s around Chicago, it was scale that outpaced integrity because, for example, the Crimean War created such a high demand for agricultural commodities that the warehouse and silo operators realized that unless they could come up with common weights and standards and ways of inspecting, that they would never be able to meet the demand. But there was this brilliant opportunity to meet that demand. And so it was that scale that pulled the integrity with it and effectively put Chicago on the map as the center, the epicenter of the global commodities market. Yeah. And so, but that's a very difficult notion, I think, for the carbon markets to accept that, in fact, we need to boost demand so that we create the demand for the integrity standards that we know are necessary for the market to scale. But to sit around and wait and to put all of this incredible effort into, as Amy and ICBCM and others have, into building integrity, and expect that to then bring demand along is a slightly ahistorical view of the way financial markets evolve. And so that I'm not smart enough to know how to solve that problem, but that's the problem as I see it.
Okay. Yeah, and I think that's the problem that we're all grappling with. This is realization that, like, okay, now how do we actually spur this demand to materialize? So, but I'll take the other side of that argument as well, because I've spent my career helping to advise corporates and helping to build these portfolios. One thing I know about corporates is they like clarity, consistency, and certainty. Right? They want to understand that if they're going to be buying something, they want to know, what's the delivery schedule? Is it going to be on time? Is it going to be relative to price, so that they can avoid compliance obligations, et cetera? So they need to have that level of certainty. Our market still seems to be fragmented with regards to a lot of bottlenecks that we've unpacked in different conversations, but I think I'd be remiss if I didn't mention them. But the time frame at which it takes to get a project from registration to ultimate issuance seems to be one of these pernicious issues here that prevents from scale really to unlock. But we could speak eternally about that. Potentially now I can just come back to something that you mentioned earlier around this. So certainly the core thesis at GCMU, which is essentially, that we need to have this shared infrastructure. And interestingly, the U in GCMU is utility. So maybe the question that I should be asking here is, in this context, is, what is a utility specifically? If it's not necessarily government owned, you called it, I think, shared foundational infrastructure or something to that effect. Can you elaborate in terms of what you mean essentially by utility and how that's materializing here in carbon?
Yeah. So what we've built at GCMU is a robust registry, a registry of title, and we can go into that as well, and one that is governed as a utility, governed as a piece of infrastructure that is essentially has a fiduciary responsibility to scale the market, not to fatten its own financial margins. That doesn't mean that this utility or any other can operate at a loss. It needs to be financially sustainable, but the fiduciary imperative of the GCMU, as is the case for any of the other pieces of utility infrastructure we mentioned, is to do what's necessary to scale the market, to bring as many participants into the market as possible. So in that sense, utility is the right way to think about it. And the governance of a utility is the right way to think about it. In a very concrete sense, for example, that means that if at any point we at the GCMU are faced with a decision where we can invest in one direction and increase our margins, but not increase the size of the market, or invest in a different direction that increases the size of the market, but not our margins, we are required to opt for the second, not the first, right? And that's the way we're structured. We're controlled by a 501c3, a U.S. charity, and that's the fiduciary responsibility that we have. It is also, as I said, a robust piece of infrastructure. My view, again, based on my experience in other markets, is that if you want to build a piece of infrastructure that really scales the market, it needs to be infrastructure that the financial players in that market feel comfortable relying on. So it needs to be robust in every sense. And that's why what we've built is a registry and a registry only. We're not connected to other commercial activities. We don't, or other activities at all. We don't, develop methodologies. We don't encroach on all of that good work that the independent crediting standards bodies do. We're not monetizing data. We're not connected to an exchange. We don't have any other commercial incentives that might cause us to stray from that fiduciary obligation that we have as a utility. And of course, we built the infrastructure so that it meets all of the high standards of information security and the like. And then I called it a registry of title. One of the very striking anomalies of this market compared to the markets I'm familiar with is that no one has been able to tell me hand on heart that the transfer of a credit from a seller to a buyer is a true sale, is a true transfer of legal and beneficial ownership. We've built a market that is assuming that that's the case, but there is no clear sense in which that is an enforceable statement. And that's a problem, because if we want it to be a market is a place where things are bought and sold, ownership is transferred. And if we don't have a clear, robust basis for ownership and for the enforceability of those ownership rights, then there's something very fundamental missing. There's a very fundamental weakness in the market. So we've been at pains to build a protocol that allows for the issuance and the registration of a credit and creates title to that credit that is enforceable, we think is enforceable. The benefit of that is
Does that span jurisdictions? Because ultimately now you get into this cross-border aspect.
Yeah.
So how do you create that universal language around the transfer of title?
Well, in the case of intangible assets, you've got one thing going for you, and that is that it can effectively exist anywhere. And so we've established GCMU within one jurisdiction, and we've convinced ourselves that the protocols for issuance and registration satisfy the basic conditions for property in that jurisdiction. That doesn't mean that's the only jurisdiction in which that's the case, but it means that it is the case for that jurisdiction. Now, those credits that are issued and registered in GCMU could be connected to projects anywhere in the world. And so, we don't need to link the credits themselves and the registry to the jurisdiction within which the project exists. That's the benefit of intangible assets. That is not an unfamiliar concept in other markets. That is the functional equivalent of saying that when Kenya issues a sovereign bond, that sovereign bond is effectively registered in Euroclear. Or if Mexico issues a sovereign bond, it's effectively registered in DTCC in New York. And so that's the analog that we're trying to build around. But when Mexico issues a sovereign bond and in dematerialized form, it is registered in the Depository Trust Corporation, everyone knows exactly what rights and obligations and what kind of title exists. And so an entire, very large, very deep and liquid market can be built around that. For our purposes, the benefit is that it means that it should be far easier for a lender or an investor to say, okay, I'm going to lend to a project. I'd like to use the basic tools of project finance to do that because they're familiar to me and I do it in every other sector.
And I can actually collateralize this with a legal title.
Exactly. I want to be able to collateralize this with the output of that project, as I do in every other sector. And now we have the technology, the legal technology to do so.
Okay. So that's really interesting. And it's not the first time that I've heard of this, but as you said, it's a very, I guess, it's a really critical and important area for a foundation for a market to evolve, but it's been bogged down in terms of this very fragmented market that we have, different standards that operate independently of one another, that certify the outcomes, but they also take on the role of issuance and then have the registry relationships that then interoperate with the exchanges. Intermediaries such as ourselves operate on those rails, but as you said, having that certainty with regards to legal title can actually help to support this market, because obviously if there's any disputes, it's the backbone for the dispute resolution. So I completely understand, and I appreciate you giving us that context. I think it's really an important function. But I want to come back to this concept of utility, right? Because so firstly, so many different participants are going to benefit from that universal, foundation of that utility. First question is, who's going to pay for that if it's antagonistic, like you said, to their own financial imperatives immediately, but ultimately going to benefit from it. So how
Mhm.
are you then building that infrastructure out, and who's effectively underwriting that investment?
Yeah. Well, at the moment, we are building it with charitable capital, with philanthropic capital. And so we're lucky enough to have the backing of important philanthropic investors. And we've got enough to be able to build what we can deploy in the market. Eventually, as I said, we need to be financially sustainable, as any other piece of utility does. And so we'll generate our own revenue on the basis of the fees that we would charge along the way. But they would be de minimis fees, certainly in a scaled up market, which is appropriate for a utility, right? A utility, especially one that eventually commands a big footprint in the market and therefore has perhaps the ability to extract what, economists would call monopoly rents, needs to be constrained from doing so. The way in which we would be constrained from doing so is that would violate our fiduciary responsibility. So in that sense, the utility construct is the right construct. But we would charge fees in order to be financially sustainable, just like all of the other examples that we've been talking about have been doing that. The problem which you're hinting at is a serious one, and that is that if you're building something to provide a public good, and you approach someone and you say, you and I agree that this public good, whether it's a registry of title or a data schema or payment rails, is necessary for this market to scale up. And you and I also agree that if this market gets 10 times bigger, then your business is going to be 10 times more profitable. So why don't you invest in this infrastructure? That my interlocutor very sensibly may say, you know what? Why don't you go find other investors? Let me know when you've built it and I'll free ride, because that's the nature of public goods. And of course, if everyone says that, then no one invests at all. And this is part of that epiphany, right? Part of that problem that we need to overcome as a market, right? Where at some point a collective, right? Everyone in this market needs to link arms and say, you know what? If we all put in a little bit of money to build this, then we will all benefit. None of us on our own would view that as a profitable investment. It's not going to generate dividends for us. It's not going to generate the IRRs we're looking for. But if we do it collectively, then it's not a lot of skin off our back. And what we would get in return is a scaled up market that means a much more thriving business, right? It's easy enough for me to say that. It makes perfect sense, but it's very hard, in fact, to get all of the different market participants to act in a coordinated way. So that's the challenge. And if you have any brilliant insights as to how to overcome that challenge, I am all ears.
Yeah. No, for sure. I'm reading some interesting books here. And so I had a previous guest, Owain Johnson, on the show, and he talked about plastic trades in environmental and also oil markets, but also looking, he wrote the book on treasury and futures and options. And so I'm gleaning a lot of these insights in terms of history. So perhaps that kind of leads to something you said earlier, and kind of my reflection here. It's let's learn from the past. When we look at, the utility is a really great concept. But there's an analogy to sort of the clearinghouses in commodity markets, and it's this shared infrastructure that wasn't necessarily government or public infrastructure that was mandated by the state. Essentially, it was a bunch of competitors coming together and saying, "Hey, we need to build this clearing clearing house." I think CME did it sort of in 1920s. So I think it was something like that. But it was a non-profit again, still member owned exchange, and so economically the infrastructure was funded by the exchange and its membership rather than the taxpayers. What's the analogy here? So are we going around to all commodity trading houses, VTOL, Trafi, the banks, etc., and essentially saying, hey, we need you guys to kind of sit around a big round table and put some dues in to kind of kickstart this foundational piece of architecture for the market? How do we do it?
That would be the most obvious way to do it, right? The Depository Trust Corporation is owned and governed by all of the broker-dealers, and they pay fees in order to maintain it. And those fees are essentially proportional to how much they use it, how big they are.
Yeah, how big they are. And that works because that works at scale. The big guys can afford to pay bigger dues, and the smaller folks pay obviously commensurately less.
Correct.
Yeah.
And the same is true for Swift. We talked about the emergence of the soft commodities trading back in the mid 19th century. It was really the Chicago Board of Trade, which was a trade association at the time, which was a sleepy little organization that could, had to offer free booze in order to get people to show up.
As often is the case.
Yeah, as often is the case, until this sharp increase in demand, in part because of, what was going on politically in Europe. And at that point, it was the silo operators who said, the way we operate today just doesn't work for us. I've got a silo. It's divided into bins because Farmer Jim makes a deal with some merchant and then deposits the grain in Farmer Jim's bin in my silo. And then the merchant comes and insists that the only grain that he will take delivery of is Farmer Jim's. And so I've had to divide up my silo into all of these different bins. It's never more than half full. And this just doesn't work. What we need to do is we need to create fungibility.
Yeah, fungibility.
We need some grading system and some inspection system so that Farmer Jim and Farmer Joe and Farmer Rene can all dump their grain into one big silo, and I can manage it more efficiently. I'll give them a receipt in exchange, and they can sell that receipt to the merchant, and that receipt can come and deliver it and say, I want the bushel that I own, and that bushel may be Farmer Jim's, but it may be Farmer Rene's bushel. And it was that revolution, those warehouse receipts, which effectively became financial instruments, and at some point then could be delivered into futures contracts, which caused the exponential growth of the commodities markets. All of that, right, was at the behest and motivated by private actors, by the warehouse owners, by farmers, and by merchants, coordinated by the Chicago Board of Trade. And it was only later that Illinois and then the federal government incorporated those systems into legislation and into regulation. So it was the private activity and these private conventions that evolved that then informed the policy and the regulation rather than the other way around. And we have the makings of that in the carbon markets, right? I mean, you referenced Amy Merrill, my CBCM. They're doing, great work with their assessment framework and the CCPs and all of the rest. We need the market to coordinate around that and say, one thing is the set of standards themselves, but we need the infrastructure to enforce those standards, to incorporate those standards and make sure that we can turn standards that are on paper into true economic incentives, which is what the infrastructure delivers. So, that's the way I think about the evolution. And as you say, I think it needs to benefit from the investment of those who will eventually benefit from a scaled up market. We can't wait for governments to do this because that's just not the way it's worked in other markets. Yeah.
I really like that. And I want to try to unpack it. There's a lot of things that you said that really resonate and are really interesting. But effectively, I can summarize the first thing that comes to mind, which is in bilateral trading, every counterparty has to assess every other counterparty, and it's clunky, right? It's typically, like you said, Farmer Jim, et cetera. It's you know me, I know you. With KYC'd AML, we do these transactions, and that's what the market has devolved to. That's where I started in my career. This market was very much a farmer's market, bilateral in terms of trading, and the word that you use is standard. I want to take it one further. It's standardization, right? So we've got standards, and when we saw, and I was fortunate to be at the kind of the nexus of that at Expansive when we launched the first futures contracts with CME Group, right? Our role at Expansive and CBL was to effectively build the underlying liquidity of the underlying instruments, innovate and say, okay, here's where we see deep pools of liquidity, and what do these instruments all have in common? Let's create the standardized contract, and we did that. We built a strong spot market, and then CME was able to build on top of that and build out the futures. The GEO and the NGO contracts were very successful launches in the context of historical launches for CME. We saw this, like you said, as soon as you had the ability to hedge and had derivative markets, we saw effectively, I don't want to say quantum leap, but a step up, right? In terms of just an order of magnitude in terms of participation, institutional capital coming in, hedge funds, trading houses, banks, et cetera, being able to trade and trade the derivatives, not necessarily the physical. And that enabled the market to grow. And the traditional sort of commodity traders were able to provide a really important role, which is that they were able to intermediate between the physical and the derivative markets. And we saw the market grow. what the confidence crisis did is essentially erode the confidence in the underlying and halted the market. But we've already seen this evolution. I think we can redo it, but do it better this time. And ultimately it comes back down to what you were talking about before, is this building of these clearinghouses or the utility. And essentially it sits in the middle and standardizes the margining, the collateral, the default management, the settlement, counterparty exposure, et cetera. And essentially these financial market utilities exist precisely because bilateral trust becomes unmanageable at scale, right? The Chicago Fed describes, these utilities as essentially critical to ensuring that payments, clearing, and settlement functions smoothly to mitigate that settlement risk. Today, carbon still has a lot of, like, as I said, I know you, you know me, handshake deals, and then we'll paper it, right? And that works at small scale, like $2 billion, but it becomes ridiculous to manage that risk at $100 billion or at $1 trillion. So effectively, at small scale, relationships substitute for that infrastructure, but at an institutional scale, infrastructure has to substitute for relationships. That's how I sort of see that shift. And
That's absolutely right.
So now the question begets is carbon still operating like a relationship market? I think I've kind of led the witness here, but essentially, when it needs to become a systems market, give me your thoughts.
No, that's exactly right. One of the businesses I ran, as I mentioned a little earlier, was a bond underwriting business, but we also did private placement. So in the credit markets, in the markets for lending, there are bond markets, which are big and deep and huge and very liquid and lots of derivatives associated with that and the rest. But alongside, there are, at a much smaller scale, a private placement market, a market where someone with money and someone who needs money sit down and bilaterally hammer out a lending agreement and literally hammer out every term and every condition in that loan agreement. And it takes months, but they may have very good reasons why they want to engage in this bilateral lending and borrowing. And that's not scalable, but it coexists, right? There may be reasons why that small, very bespoke, very by appointment market should exist. And that's what we have today in the carbon markets. Right. But what we need is the functional equivalent of the bond market as well. And why are the bond markets so big and so deep? Because there's so much standardization, because so much of a prospectus of a bond is boilerplate language that everyone understands. You can skim through 120 pages and you only really need to read 5 of them, because all of the rest you've read a million times before. And because there is such standard institutionalized ways of evaluating bonds, buying and selling bonds, writing contracts on those bonds, all of that has been standardized. It's been standardized often with the help of trade associations like the International Capital Markets Association and the like. And that standardization is the path to scale. Right. So there's no need to say, because we need scale, we need to eliminate this by appointment, bespoke sector of the market.
It'll always exist, but hopefully it gets eclipsed
that can always
with
exist.
a much larger institutional framework.
Exactly. And so we've got to establish those standards, and then we have to build all of the infrastructure that can effectively be coded with those standards so that the market can truly scale.
Okay. Great. And so it kind of brings me back to something that you said earlier around everyone benefits from the utility, but essentially competition sits above that, right? So brokers, traders, exchanges, everybody can still coexist, right? On in terms of the payments and the transaction layer, but the registry of title sits as the foundational element. Is correct? Just how you're articulating
That's
it?
absolutely right. Yeah, that's exactly right.
So
the New York
customer
Stock
relationships,
Exchange,
all that sort of stuff sits with the trading houses, with the banks, pricing, discovery, capital formation, et cetera, all above it. And then this is just a registry of titles that if there's ever a problem, it gets settled there, literally and figuratively.
Correct. Right. So in the securities markets, in the market for stocks and bonds in the United States, for example, Goldman Sachs, my alma mater, is not running the Depository Trust Corporation. The New York Stock Exchange is not running the Depository Trust Corporation. But without the DTCC, without that oxygen, which is invisible, the market would die. Right.
Yeah.
But they make, as we know, incredibly brisk business in the stock markets and in the bond markets, thanks to that fundamental infrastructure. And they will readily admit that they don't want to run it, they don't want to control it, but they're sure glad that it exists.
Yeah. kind of thinking of an analogy here. It's a bit crude, so indulge me. But effectively, markets compete on roads, but they shouldn't have to compete over what a road is. So ultimately, this infrastructure enables them to be able to understand that's the road, and now we can compete and race on that road itself.
That's it. That's exactly right. I don't actually think that that's too crude. And it's and it's and the challenge is there too, right? I mean, we live in a society in which people believe that it is perfectly within their rights to buy the most expensive, fanciest car they can possibly afford to buy, but they often balk at paying the taxes to maintain the roads, without which that car is no fun at all.
No fun at all. But and if you've been to any developing economy and you see the state of certain roads, you understand exactly that. I was in Vietnam a couple of weeks ago, and I saw a guy with a Maybach, and I thought, with the quality of the roads here, that's probably not the best car.
Yeah.
I digress.
Yes.
So okay, but Chris, interesting. So I thank you for all of that context setting and establishing the need for and effectively the raison d'être for GCMU around building this public infrastructure. And you called it, a public good, but I'd be remiss if I didn't, push back a little bit, because ultimately there's obvious. I shouldn't say obviously there's an obvious, but there's an obvious counter argument, right? ICE, Expansive, S&P, MSCI, Silvera, B0, all the registry providers, my alma mater at Expansive, with APX, etc. They're building infrastructure commercially, right? And they're building it all, and it's, like you said, for commercial benefit, commercially, and there's this kind of infrastructure wars that are going on. It's the interconnectivity that is now kind of the connective tissue that is kind of binding them. Should they stop in building that and then help to focus and build in this underlying registry for title? How does that kind of tension work between the commercial effectively and then this public good theory is ultimately what I'm driving at?
Well, I think that Expansive, APX, S&P Global, ICE, Trovio, all of those entities are going to be, all of those commercial actors are going to be critically important to scaling up this market. None of them should feel that they have an obligation or that there's a strong financial case for investing in the basic foundational infrastructure the market needs to scale, any more than the New York Stock Exchange feels the need to invest exclusively in the DTCCC. And so I think that there is no competition, as far as I'm concerned, between what we're building and what they are building or have built, and the two complement each other very nicely. The second point I'll make is that what is evident from many, many other markets is that if you leave it exclusively to commercial operators to build infrastructure, then there'll be a bias against standardization. Why? Because standardization is, in effect, a form of ceding control. In this case, in the carbon markets, it's control over data. If you make data, all of the data publicly available, for example, then much of the rent extraction that comes from manipulating that data goes away. And so you wouldn't expect commercial actors to be all that keen on standardization. They benefit to some extent from the opacity and the fragmentation. And there's nothing wrong with that, but that's not the path to scale. And so that's why there are strong disincentives for commercial actors to build the foundational infrastructure that every market needs. And I say that again with confidence, not because, I've got better insights than anyone else, but because I'm at pains to find an exception to that rule in any other market. All right. And so I don't see why this market is so special that it should be the exception to that rule.
I really like that, because I think that's something that we're all guilty of, right? In this market where we talk about and pontificate about carbon, and it maybe comes from NGO type of roots that folks have, and this kind of ideology that brought us into these markets. But you're completely correct. It should not look and act different to other markets. We should embrace that markets can actually be a force for good and ultimately to help to scale. And that kind of leads me to this kind of ultimate objective. And I don't want to put words in your mouth, so please, correct me if I'm wrong here, but the objective here shouldn't be infrastructure for just infrastructure's sake. It's really to make carbon markets easier to finance, easier to trade, easier to trust, and effectively easier for institutional capital to participate, right? That's what we talk about when we talk about scale. So then, I'm conscious of time. So maybe I'll come here to some kind of concluding questions, around what the finished architecture actually looks like. So now let's fast forward effectively. What would be visibly different about the carbon market, let's say 5 years from now, if GCMU succeeds in building this foundational layer for the registry of title?
Well, I would like to think that it would be a lot bigger, because there would be a basic layer of infrastructure that most financial players and project developers and buyers felt comfortable relying on. They would do their due diligence on it once, and then that would be it. They wouldn't have to think about it again, and they could begin building their own processes for evaluating projects, for buying and selling, for lending to projects on the basis of that, and so it wouldn't be an exercise of starting from scratch every time you've got to take a project to a risk committee or to a CFO.
And that friction is real. What you're highlighting.
That friction is real.
Absolutely real. It makes it really difficult to be able to work with the developer to say, let me help you to commercialize this pipeline of forward issuance of supply that you're bringing to market, because ultimately you're having to negotiate each and every single time with a buyer that is continuously doing super in-depth due diligence, and it just grinds to a halt. So to your point, having that greater transparency, it would be key. A trust layer. Exactly.
And over time, we would have infrastructure in which, for example, a common data schema could be encoded and effectively enforced. And now all of a sudden, all project developers are developing their PDDs and other information packets in the same way they would if they were issuing a bond or issuing security. And that would make it that much easier, for example, than for the ratings agencies and
insurance
and the exchanges and insurance to get that information, know exactly what it is, know that if a line has a certain name, they know what the definition of that line item is, rather than having to wonder whether revenue or location means something different in project A than it does in project B. Right? This infrastructure becomes, in a sense, the handmaiden for all of that standardization that makes everything else that much more efficient. And I would like to think then that the opportunities for commercial actors like today's registry service providers, like today's exchanges, get that much bigger. And so in some sense, they may be pulling back, narrowing the work that they do, because they no longer need to be responsible for those registry adjacent activities. But the rest of their business gets bigger, by 10x. Which is, of course, what we need in order for this market to be big enough,
and everyone stays in their lane.
Impact.
Completely. I think that that's the trajectory that we're on right now. So I see that with Vera and the new registry that was just launched with S&P, right? So we're seeing effectively delineation that Vera is a certification body, and now the registry provider is a big financial institution. Not that expansive wasn't before, but obviously they got to choose where they took that business. But we're seeing that separate kind of separation of church and state effectively. And then to your point around having that universal language, effectively the data schema, I think you used the terminology. I think we're already seeing signs of that. I spoke with Mandy Rambaros, and also Vera CFO, Chief Technology Officer Joe Delofino a little while ago. And they were talking about essentially digitizing the project design documentation, the PDD, so that there would be a comparable apples to apples, as opposed to what David Antonioli, the former CEO of Vera, called the creative writing exercise. PDDs are really laborious, like you said, and they're not standardized, and every single one is this unique, prose, and you have to read through all of this technical jargon to get to the outcome. The methodologies are there, the calculations are there, the science is effectively universal, and now certain inputs can just be put in, and we could actually lead to higher and greater throughput in the review process if they had a standardization template to reference, as well as leveraging technology like in the nature-based case geospatial data, et cetera. So
Mm-hmm.
that I think we're seeing that, and we're seeing not just the digitization of methodologies and the corresponding PDDs, but obviously the registries themselves and enabling tools like AI, agentic AI, to be able to provide a better, more scalable, coming back to this word, scalable throughput, so that ultimately we can yield more outcomes, the carbon credits on the other side. So that's good, but it will take some time. So I guess,
Yes.
I've got a couple of final questions, if you'll indulge me. Do you think that we eventually get to a point where carbon credits can be financed, collateralized, insured, risk managed like other assets? And we talked about certain examples of each one of those aspects occurring, but not like other financial assets. It's very much on that bespoke basis. Do you think that standardization actually takes hold, and that we do emerge as a market as opposed to as an industry?
I do think so. I think that often when someone is asked that question, they think, well, will the carbon markets ever become like, let's say, the crude oil markets? And, that's not possible because there's so much fungibility that already exists in the crude oil markets. And there's so much bespokedness in the carbon markets because every project is different. So we can't possibly aspire to that. But I think when you immediately gravitate to that kind of parallel, you ignore a whole bunch of other markets, which are much, much bigger than the carbon markets are. I'm thinking, for example, of the market for aircraft equipment. Literally every piece of any commercial aircraft flying today has been leveraged to the hilt. Part of the reason it's been leveraged to the hilt, it's collateral for a loan, is because the basic infrastructure, the basic registry infrastructure for aircraft equipment was created by treaty 25 years ago, the Cape Town Convention, the Cape Town Treaty, and a registry was built. It's called the International Registry for Mobile Assets. No one knows it exists. It exists in Ireland, but it is part of the reason that is such a huge market. If we could get the carbon credit market to be that size, we should be, congratulating ourselves. That's not as big as, the market for coffee or the market for crude oil, but it's big enough to have climate impact, which is what we're here to do.
That's what we're here to do.
And so let's not be disillusioned because we can't see a path to this becoming one of the big, great, deep, huge commodities markets that we sometimes imagine when we think about the future. There are intermediate stages of adolescence and early maturity, to go back to the first part of the discussion, that are certainly good enough to make a difference in the climate, and that's what we're here to do.
Yeah, great. I really like that, Chris. Thank you. What I find really interesting about this conversation, discussion, really was so much that the carbon market debate just happens at this visible layer. Oftentimes, we talk about projects, credits, methodologies, integrity, buyers, claims, et cetera. And we kind of forget that underneath all of that sits this less visible question: does the market actually have the infrastructure required to function at scale, as you've outlined? So I really enjoyed that. I think there's a lot of lessons, hopefully, that the audience may have taken away from that, and I think that'll hopefully determine whether the carbon markets remain, like you said, relatively bespoke and fragmented, or evolve into something larger, more institutional, in terms of attracting that institutional capital that these folks can participate in. And I really like that analogy around other markets. We don't necessarily have to shoot for the largest markets in the world and replace very well established commodity markets like the energy complex, but there are very attractive other markets that if we could scale to that size would be really great. And I'm not here to undermine essentially the size of the carbon markets, because when we look at carbon markets globally, it is measured in trillions of dollars, led in large part by compliance systems like the EU ETS and California Cap and Trade Regi, et cetera. When we're talking about this kind of convergence around Article 6, CORSIA, voluntary carbon markets, it was still measured in billions of dollars, perhaps single, perhaps double digits, certainly not triple digits in billions, but we need to see that scale measured in trillions. And I think that there's a lot of middle ground there, as you've intimated. So again, thanks, Chris. I really appreciate your time. I learned a lot, and thanks for joining me on This Week in Carbon.
Well, thank you for having me. Thanks very much.
Thanks. And just obviously a reminder to the audience, please feel free to subscribe and hit that like button, and we'll see you next week. Thanks again.